Welcome to Livewire's Fund and Focus. I'm Hunsley, and joining me today is David Stonberg of Neuberger Berman. David is the firm's Deputy Head of Alternatives and its Global Co-Head of Private Equity Co-Investments. And he is also on the team that manages the Neuberger Berman Global Private Equity Access Fund, which is our subject today. David, welcome to you.
Thank you, Hans. Happy to be here.
So, David, there are plenty of private equity funds and fund operators out there. So what do you think is the Neuberger Berman Global Private Equity Access Fund's point of differentiation?
Sure, terrific. Thank you for asking the question, Hans. So I think we bring many attributes to the table in this fund. First is we're doing deals directly into companies alongside many of the leading private equity firms of the world. So it's direct deals. And why is that important? There's fee efficiency in that, in our model and the way it's built in. Second, it's with a diverse group of leading private equity firms around the world, diverse, small, mid, large, mega, US, Europe, Asia. So you're getting nice diversification with access to the leading private equity firms in the world in a fee-efficient way. On top of that, this vehicle sits in the same waterfall as our other pools of capital for doing co-investments, broadly speaking. So getting access to the same team, platform, deal set, information opportunity that we bring to the table for all those pools of capital. So we think this is a product that can be the sole private equity commitment for investors who want to use it that way, given its diversification and the fee efficiency that it brings to the table.
With that said, then, David, I wonder if you could give us a brief illustration of your investment and due diligence process.
Sure. So there's a couple different ways of looking at that. Around the world, we have about 80 plus people working on co-investments every day. What does that mean? Working on them, sourcing them, diligencing them, executing on those transactions. On a weekly basis, we're going to have a couple of screening committees, an investment committee meeting. We're going to diligence that investment opportunity, try and understand the key tenets of that investment opportunity from the leading private equity firm, and really try to understand why is this something that this particular private equity firm wants to do, and how are they going to make money with it? And do we see the world the same way they do in this particular investment? That's at a very high level. Secondly, I guess looking at it from a different lens, what we typically look for are good businesses. What's a good business? A good business is one that's growing faster than GDP, probably doesn't have customer or supplier concentration, is not going to be cyclical, is going to have good free cash flow dynamics, probably has a good management team already there, right? So kind of good company, good industry. Then secondly, the private equity firm that's buying it, are they the right firm? Are they the right ones to create to put into place the value creation plan that doesn't make sense for that particular asset? And then is it a good deal? What we mean by is it a good deal? Do we like the valuation? Do we like the capital structure? Do we think there will be people who want to buy it when they've instituted this value creation plan? So I kind of think about those from two different lenses. One is around process. Second is around kind of what typically comes through the process.
Yeah, no, absolutely. So with that said, how big is your opportunity set, and how many businesses would you end up owning stakes in at any one time?
Yeah. So the opportunity set right now, we're seeing about 600 co-investment opportunities per year, a little over 11 per week. That's a terrific opportunity set. So we have certainly great, and many of those from really the leading private equity firms in the world. So we're thrilled about the opportunity flow in the set that we see. And in a vehicle like the one that we're talking about here today, at maturity, we would expect to see somewhere around 100 to 150 portfolio company investments in there.
Okay, David. So as I best understand it, this fund was launched December 2022. So given that particular time that the fund has been around, what type of returns are you aiming to achieve? And I guess where does the fund sit in a typical client asset allocation?
Sure. So on the first question with respect to returns, I think what we're looking to deliver from our returns, what we're underwriting to is what I think most people would think of as common private equity returns, right? Now you have to keep in mind that a portion of the investments or capital in this vehicle is for liquidity purposes, call it 10-ish%, 10 to 15%, right? So that's going to have a different return profile associated with it. But the portion of the fund capital that's going into private equity investments, we're going to look for returns consistent with what people would seek in private equity industry and landscape, broadly speaking. And sorry, what was the second part of the question?
Yeah, so where do you think this fund sits in a typical client asset allocation?
Oh, sure. From a client asset allocation perspective, we've intentionally built the portfolio in the construct in the vehicle so that it can be, for those investors, it can be their sole exposure into private equity. It's got the diversification, it's got the fee efficiency, it's got the exposure to small, medium, large, mega cap buyout firms on a geographic basis across industries, sectors, et cetera. So we think it's got the diversification for those investors who want to make it their sole exposure into private equity.
And finally, David, I know that you have worked at Neuberger Berman for well over 30 years, and certainly in the alternative space for a long time. So why do you believe investors should be allocating to private markets moving forward?
Sure. So I think there's a few reasons for it. First is the expectation of return enhancement, right? So private equity has proven to deliver historically over time, 5, 10, 15, 20-year periods, excess returns relative to the public markets. I believe there's every reason to believe that that will continue to be the case on a going forward basis, given all of the resources and energy that private equity firms are pouring into making the companies that they buy better and more valuable. And I just think the governance model in private equity allows for that excess return generation relative to the public markets. Don't get me wrong, I love the public markets as well. I just think private equity has a nice place in investors' portfolios to be able to create that incremental return enhancement.
All right, excellent. David Stonberg of Neuberger Berman, thank you very much for joining us.
Of course, thank you for the time, Hans.
And thank you for joining us. If you would like to watch more of our Fund in Focus series, or indeed learn more about this particular fund, you can go to livewiremarkets.com.